Book value per share represents the value of a company's tangible assets less liabilities on a per-share basis. The P/B ratio is particularly insightful for companies with significant tangible assets, such as manufacturing firms, banks, or real estate developers. It helps investors gauge if a stock is over or undervalued relative to the accounting value of its assets, offering a grounded perspective on a company's intrinsic worth based on its physical and financial holdings. The P/B ratio holds particular significance in capital-intensive sectors. For industries like manufacturing, banking, and real estate, tangible assets form the backbone of their operations and value. A P/B ratio below 1.0, for instance, P/B 0.8, could suggest that the market views the company as undervalued relative to its net assets, or it could signal distress within the company or sector. Conversely, a P/B ratio significantly above 1.0, such as P/B 2.5, indicates that the market recognizes substantial earning power or growth potential in the company's assets beyond their accounting value. However, for service-oriented or technology firms like software developers with minimal tangible assets, the P/B ratio is generally less relevant, as their value lies more in intangible assets like intellectual property. Moving on to profitability, return on equity, or ROE, is a powerful indicator of how efficiently a company uses the capital invested by its shareholders to generate profits. Calculated as net income divided by shareholder equity, ROE tells us how much profit a company generates for each dollar of shareholder equity. A high ROE signifies that management is highly effective in deploying shareholder funds to produce earnings, which is a key measure of management effectiveness. For instance, companies like Apple have historically demonstrated exceptionally high ROE figures, often Apple ROE 150% in recent years, reflecting strong brand loyalty, effective capital allocation, and robust profitability from their equity base, making them very attractive to equity investors. Complementing ROE, we have return on assets, or ROA. This ratio measures how efficiently a company uses all its assets, both those financed by debt and by equity, to generate earnings. The formula is net income divided by total assets. ROA is a critical metric for understanding operational performance, as it gives a broader view of a company's asset utilization efficiency, regardless of its financing structure. It's particularly useful for cross-industry comparisons, helping investors evaluate how well different companies,